So hello everybody. So my last part 1 video for chapter 9, we left off here, and again this is the sustainable sales growth rate to be able to grow with the internal money that you're generating. Let's go back a little bit and let's just see the all right, rate at which a firm can grow sales based on the retention of profits. So just the profits alone. Okay, so there's a couple of, really there's only one equation here, and we went through these equations, and this is probably like this is the big one, and this is really the same thing, right? These are just ratios, right? And you can see these things cancel here. TA, total assets, net sales, they cancel. All right, so a couple definitions here. And the first one is called financial capital needed. Financial funds needed to acquire assets necessary to support the sales growth, the firm's sales growth. So what this means is you want to grow, you have a target growth rate, okay, and you're going to need assets to make it grow at that rate. Maybe you need more machinery or more inventory, and you're going to need this amount of funds. So these are the financial capital needed to grow at your target growth rate. All right, so spontaneously generated funds is the increases in accounts payable and accrued wages and taxes that are going to occur with a sales increase. So these are going to be more costs, right? You're going to generate more sales, so your accounts payable is going to go up. You're going to owe people more money, and your accrued wages are and taxes are going to go up. So these are generated funds, okay, that you're going to have to eventually pay out. Okay, so you're going to have to somehow deal with paying those funds off eventually. All right, so additional funds needed is the gap remaining between the financial capital needed and that funded by spontaneously generated funds and retained earnings. So the additional funds needed is what you need in assets, right? Minus what the spontaneously generated funds that you're going to have to pay out eventually, and the increase in the retained earnings which you decide to keep. So this is really a simple equation. It's basic. It's just that they're taking these funds needed okay, and so so if you look at the difference here, you just subtract these two off. So this is what you'll need to increase the sales growth after you take off the spontaneously generated funds and the increase in retained earnings. All right, so that equation is a little complicated. So here it is in words, and they take these three components and they break these down in 3 parts in an equation. So watch carefully. This is the first part, right, of that equation. This, after the subtraction, this is the second part. You see that? And after this third subtraction, this is the third part. So if you go here, required increase in assets is the first part, spontaneously generated funds is the second part, and increase in retained earnings is the third part. All right, so you got those 3 parts right here, and here's how they're defined. And again, the math is simple. The only thing you have to know is, you see it's a total assets here. Well, there's a little 0, and that means now. That's current total assets. That's 0, and see there's 1 right there. That's future net sales. So when you see like a little 0, that's now, and when you see a 1, that's in the future. All right, so they tell you what each thing is here, and the next slide is real important because they do an example. And they give you all the items here in a sample, And you just plug these into the equation on the previous slide, and you'll find your additional funds needed is $68,000. So, you take each term and pop it in. Just go through that carefully. All right, so there's two terms here that are important. Percent of sales method, and you make projections based on, now this is basically you're projecting. See, that's the important word right there. You make projections, and we're going to look at this with regards to a balance sheet and an income statement, right? And a cash flow statement, actually. Now it's the future projections. And there's another type of method that's used. There's two methods here. Constant ratio method. It's a variation of the this method here, percentage of sales method, that projects selected cost and balance items at the same growth rate as sales. So there's two methods here. And I believe they have an example of the first one here. All right, so we're going to look at forecast, and you should do this on your project. You should project sales, and you should project income statement, and even just for a year, go out every month for a year, and you do that. So these would be important for your balance sheet. I mean, for your business plan. Right, so, all right, so here's a projected income statement, right? And you'll notice this is the actual numbers here for 2016. This is actual. And now here's where they forecast. See, the magic word is forecast. And they're telling you that the sales should be 30% higher for 2017 over 16. So they show you the ratios here, 1.3, 0.6. So this is the projected forecast for 2017. So we're projecting things out, right? See, actual and projected. Here's the balance sheet, same deal. Notice the forecast ratios: 0.1%, 11.5%, 0.2, 20%, 32.5%. So all these percentages. And this is based on the 2017. Notice how it's based on the 2017 sales. So let's go back for a minute. Those are multiplied by, here's your 2017 sales. So your budget, your balance sheet is based on that, right? So, and you get these numbers. So you multiply these and you'll get these numbers. Okay, here's the statement of cash flows, and as you remember, again, this is projected. This is projected. And there's three components, remember? Net cash from operating activities, financing activities, and investing activities. Investing, operating, and financing. It should be a good review. So these are your forecasted cash flows. And most of this information will come off of the income and balance sheet. All right, so I guess that's it. So the important thing is a couple of equations here, all right? You should know these equations. Let's go over those equations just as a review. Right, here's an important equation. So this is the additional funds needed. And again, practice with that. And here's the sustainable growth rate written a couple different ways, right? So, you should read the chapter carefully on here. So here's how they start it, and it grows from there. Okay, so I hope everybody's well. This should finish up chapter 9.